So I wanted to discuss with you something I call the risk management quartet. Where does risk come from? Risk does not come from stop loss only. There are many other sources of risk which I wanted to discuss with you. If two traders are looking at the same stock, that does not necessarily mean that they should take the same position size in that stock, because position size is directly related to risk. And when it comes to two traders, their risk situation could be completely different from each other. That is why I say position size is not constant across. There is no one size fits all. Some traders should trade with a small position size, some traders should trade with a large position size. To understand position sizing, you need to understand risk, which is what I want to discuss with you today. So, where does risk come from? Primarily comes from these four factors: the stock, the market, the trader, and the situation. Let's talk about the stock. In stock analysis, we are doing liquidity analysis, comparative analysis, technical analysis, fundamental analysis, and market analysis. Correct? Market analysis comes here, but in stock, we are doing liquidity, comparative, technical, fundamental. Now, let's say in liquidity, the stock does not have average daily volume of minimum 200,000 shares. Well, in that case, that fact is contributing to risk. I am not saying don't buy the stock. I am saying that fact is contributing to the risk in the stock. When it comes to comparative, let's say the stock has a relative strength of 63. Well, it is less than 70. It is contributing to risk. If you look at technicals, if the stock is extended, if there are no 10 candles in the base, if there are no 4 points in the base, then that is risky because it doesn't meet our criteria. The stock is technically extended in price. When it comes to fundamentals, well, fundamentals, let's say the stock has minus 25% latest quarter EPS growth. Well, that is risk, correct? You understand that is risk. So, liquidity, comparative, technical, fundamental, we are analyzing so that we know what is contributing to risk. So, focus on those factors which are not in our favor. I have noticed that my subscribers and my students are only focusing on those factors which are in our favor. And they convince themselves that, okay, this is a good situation to get into. No, focus on those factors which are not in your favor. That will tell you where is the risk coming from. Okay. Next, market. We all know there are four market conditions: confirmed uptrend, uptrend under pressure, rally attempt, and confirmed downtrend. We all know that in William O'Neill's book, it is written that the market, when it is in a confirmed downtrend or when the market is weak, 3 out of 4 stocks will not make you money. So, which means when the market is weak, there is a 75% chance that you will lose money on that particular trade. So, the market situation contributes to risk. If we are in a favorable lenient market, low risk. If we are in a market which is under pressure or which is trying to rally from the bottom or which is in outright downtrend, more risk. Okay. Third is the trader. Well, here I am talking about the behavior of the trader. If a trader has an argument with his spouse in the morning, and if he tries to take a trade during the day, there is a good chance that he might mess up in trade execution. There is a good chance that he might want to take revenge from the market by putting up larger than normal position size. Rather than putting 10%, he would end up putting 25% just because he could not win an argument with his spouse. So he now wants to take that revenge from the market. That's trader behavior. That's trading psychology. Or just in case if you have had a bad day, you are not objective in your thinking. So your analysis here might be faulty. So you're overlooking certain factors that are contributing to risk because your mind is not in the right place. You are not able to concentrate. That's called trading behavior, traders' behavior, or trading psychology. So the behavior of the trader, the personality of the trader also contributes to risk. I know people who don't like to take small position size. Well, that's a inherent flaw in the trader behavior, right? If you don't like to take small position size, you are forever committed to taking a huge position size in a stock, irrespective of whether the market is in a confirmed uptrend, downtrend, doesn't matter. That is a recipe for disaster. Okay. So trader behavior plays an important role in risk. In fact, trader behavior is the primary reason for catastrophic losses, or it destroys trading careers, trading journeys. Okay. So you could be right in selecting the stock, you could be right in understanding the market. But still, if you make a mistake while taking a larger than normal position size or forgetting to keep the stop loss, that's how silly can a trader be? Forgetting to keep the stop loss for some reason. Maybe he put the trade when he was in office, and before putting his stop loss, maybe he got a call from the boss and he went to the meeting. And by the time he came back, the stock had collapsed. Okay, can that happen? Of course, it can happen, right? So forgot to put the stop loss. That is a disaster. Okay, that's trading behavior. Risk comes from traders' behavior. Then comes situation. Well, here I am talking about personal, professional, and portfolio related situation. What is personal? Well, in your personal situation, maybe you have lost your job. In that case, will you take a big position size? No, you're trying to find a new job. You are not able to concentrate in your daily stock market analysis. You are trying to save some money. You are trying to reduce your expenses. That's your personal situation. In such situations, if you're trading stocks, you should be going in with a small position size, tighter stop loss, small risk. Well, professionally, if you are working in a toxic environment in your office, or if you have project deadlines, targets to achieve, you're not in the right frame of mind, don't trade on that particular day. You have to, your first priority is your job. You have to focus on the project at hand. If you miss a stock, that is fine on that day, because your job is more important than the stock market, at least for now, right? That's a professional situation which could prove to be risky. You're working on a project, you're trying to concentrate, suddenly you find a stock breaking out, and instead of focusing on your project, you are putting a trade there. Okay, and now you are not able to concentrate on the trade, not even on the project. Not good for you, correct? Personal, professional situation. Then portfolio situation. Well, if you are taking a particular trade, that decision depends on what has happened in your previous 3 to 4 trades. For example, in your previous 3 to 4 trades, on a net level, if you have made a profit, that will allow you to take a bigger position size on your fourth trade. On your fourth trade, you can finance the risk using the profits that you made from your previous 3 trades. However, in your previous 3 trades, on a net level, if you have just broken even, or if you have incurred a loss, then in that case, you should not be taking a bigger position size on your fourth position, correct? So that's portfolio level situation. Another thing could be age. You are a 75-year-old person trading the stock market, and you are a 25-year-old person trading a stock market. Can you go in with the same position size? No, probably not, because your life situation is very different. At age 75, maybe you have become very conservative. At age 25, you are naturally very aggressive, right? So this is the risk management quartet. Just because you have kept a stop loss does not mean that you have managed the risk. You have to look at your behavior. You have to look at your personal, professional portfolio situation. You have to look at your stock analysis. You also have to look at the market situation to understand how much risk that is being presented to you, and then accordingly take a position size. Thank you so much.